Welcome back. This is Jacob Milliken, owner of 9M Investments, and today I'm talking about portfolio income update for March. So the kind of two sides of the investment house income growth. This month, March, annualized yield of 14.69, bringing the year-to-date average up to 14.19. Obviously, a very good yield, equity-like, extreme good equity-like returns from that standpoint. And what clients do that really depends on their situation. Are we using all of it for income? Are we splitting it up and using it for growth as well? Or are we just using it to balance out the growth side of our portfolios? Depending on what you do that for is really typically done by, what stage in life you are. So kind of deeper dive into where is that yield coming from? First part of the portfolio, private real estate. Current holdings include Blackstone's Real Estate Trust, Nuveen Global Cities, both private real estate funds. Both of these are evergreen structures, which means there is liquidity. Both of these have monthly liquidity. Strategies within these funds, multifamily housing, industrial, logistics assets. Industrial logistics was kind of the first run of every company in the US building out that industrial, building out their online access, essentially kind of what drove a lot of that. And then this next phase is data centers, infrastructure related real estate. Obviously, data centers built around the AI moves and craze that we're all seeing here. Why I like this piece of the portfolio on the income side is one, it's predictable cash flow, um, lower volatility in public REITs, but then overall very low volatility compared to any type of public market. So again, a good part of the portfolio that helps anchor that income side from a volatility standpoint. Much like private credit, current holdings BCRED, Blackstone's private credit fund, Blue Owl's credit income fund, Carlyle's tactical credit fund. Again, just like the private real estate, private credit also helps with the volatility part of things. The nice things about these funds is, a lot of this used to live within the banking sector. As that changed through the great financial crisis, a lot of these private equity type companies were able to step in and offer those same type of loans. So most of these are senior secured floating rate loans. Floating rate means they move with interest rates. So as interest rates rise up, the yield on these that we're able to get go up, and as interest rates come down, those yields come down as well. So private credit is kind of past its peak when interest rates were at its highest, and as interest rates have kind of floated down, the loans within these have kind of started to flow down till as well. So, but still very strong yields, 8, 9, 10%, depending on which fund you're looking at here. And again, very much different from just kind of your CLO action that's out in the world. The nice thing about this, people talk about private credit and defaults and things like that. Well, one of the really different things with private credit is if there is a default within that portfolio, all these groups can actually step in and all of a sudden they have an equity position within this company. Now, again, is that a good thing or a bad thing? What are the recovery rates? Those are all things that can be highly volatile depending on the situation, but very different from your current CLO kind of functions where a lot of people might have seen this before private credit. On the ETF side, this is our public options within our portfolio. Things like option overlays, structured note exposures, which are fairly new within the ETF world, and then some of the private credit-based CLOs. So PCCM is taking some of those loans from those private credit, and then they've packaged that within an ETF. So within this is the smallest part of the portfolio, but this does give some liquidity, depending on which one of these can be a volatility strategy or more of a yield play on some of these as well. So, and then lastly, structured note income notes. This is the biggest driver of the yield within our portfolios. Why I like them is they're defined maturities, they have call set features, and most importantly, contractual income payments. And so, once we get into one of these notes over the life of that note, but whether it be 1 year, 2 year, 3 years, or even 5 years, we know we're going to get on a month-to-month basis. They do get called. So here in March, we had two notes called. Both happened to be with Barclays. and we added new notes with yields within the high teens. Within this world, the big driver of what those yields look like is based on volatility in the market. And so March, obviously, we had lots of volatility. Still, as of now, April 13th, we have continued volatility. So these have been a little bit higher, and that's how we get to that 14.69 number. As volatility comes down, as those kind of flow through and mature, that may come down in the future. But as long as we have that high volatility, we're going to take advantage of it and get the yield that we're able to produce. So if you have any questions, anything else like that, feel free to reach out. I'm happy to walk through how we produce income for our clients.